Everyone nowadays is talking about artificial intelligence and this boom with NVIDIA, their stock price skyrocketing over the last 18 to 24 months. And a lot of people are having FOMO about NVIDIA and things like that. And at this point in time, NVIDIA just split 10 for 1, meaning if you owned one share of NVIDIA, now you have 10 shares of NVIDIA, which also increases the supply of shares out in the market, meaning there's more supply. And typically, if there's more supply and demand remains the same, from an economic point of view, that's going to drive prices lower. So people have reached out to me asking me like, hey, should we hop on the NVIDIA train? Well, at this point, it's really expensive. And before the stock split, their price to earnings ratio was like 700, meaning the price of their stock compared to their earnings is extremely expensive. And when you are evaluating where you want to purchase a company's price, definitely matters because you don't want to overpay for a good investment. And right now, people are chasing returns, which ultimately is not a recipe for success. So what needs to happen is look for companies that their earnings are still catching up to the price, meaning if they have a price to earnings ratio of 10 to 15, that means the company is pretty cheap, and that could be a potential good buying opportunity. Because right now with artificial intelligence, we're seeing something similar that we saw in the 1990s with the internet. So with artificial intelligence, essentially what's happening is the productivity of America's economy is increasing. And with the increasing of productivity, what that's allowing the economy to do is to grow faster than it normally does, which could end up turning into a bull market, meaning the market is going to appreciate over a considerable amount of time. That's what we've seen in the 1990s. That's what we saw from like 2010 to about 2020. That's what we saw in the Industrial Revolution. We have these things come up that pushes the economy forward. People are working, people are making money. And when that happens and companies become more profitable, their stock prices increase in value. So if the economy does end up going into a bull market, things could get very exciting. On the flip side, a lot of people who want to buy houses are complaining that interest rates are high and they want interest rates to come down so that they can get a better interest rate to purchase a home. The thing with that is if interest rates come down in value, that means the Federal Reserve thinks that the United States economy could be slowing. So to make sure that we don't enter into a recessionary period, they could lower interest rates. So if the Federal Reserve lowers interest rates, that means they feel that the economy is slowing and they want to help the economy out by lowering interest rates, because by lowering interest rates, it makes it easier for people like myself who own businesses to borrow money, and it makes money cheaper to borrow so we can get more money so we can grow our companies faster. So lowering interest rates makes items like that a lot more accessible for people, and as well as it makes home prices more affordable. The lower the interest rate, the cheaper houses could possibly be for your mortgage payments and things of that nature. On the flip side, though, when you lower interest rates, you'll also be unilaterally increasing the value of all of the companies that are traded publicly. So if there's a lower interest rate, that means all of the companies are going to be worth more valuable, because that's what we saw in 2022 is when interest rates kept going up, up, up. We saw essentially all the investments. I'm not sure which ones went up in value. I'm sure there were some, but many investments overall went down in value because of the interest rate rise. However, what we're seeing is all of these companies' earnings continue to grow. And if earnings continue to grow, the enterprise value and the stock price of these companies will continue to grow with it. And that's a problem with a company like NVIDIA, is their earnings grow so fast. So that's what's called unsustainable growth, meaning they were at the right place at the right time. They have chips. There was a chip shortage during the pandemic. They were able to take advantage of this opportunity by having the chips large companies such as Google, Microsoft, Tesla. All of these companies are buying chips from NVIDIA. Will that continue to happen? I don't know. So NVIDIA, when a company gets that large that fast, they're going to have to figure out how to continue to grow their earnings. And typically what happens is they have to do that through acquisitions, meaning they're going to have to buy more companies. And that's what a lot of people don't understand is they're like, hey, NVIDIA, how much bigger could they get? Well, over the course of time, in the short run, their stock price is a little overvalued. In the long run, though, they have so much cash now. I think they have like $20-30 billion in cash. They can go out and buy companies and continue to grow their enterprise through acquisitions. And that's what these large companies like Microsoft, Apple, Google, Facebook, that's what they all do. Because once you get to a certain level, the only way for these companies to grow is through acquisitions. So you have to keep your eye out for possible companies that they could be acquiring. In addition to that, you want to look at companies that are not paying too much in dividends as well, because if a company is starting to pay a lot in dividends, that means they're not taking that cash to acquire more companies so that they can grow their enterprise value over time. With that being said, it's an exciting time for the markets, and you never know when the best time to buy is, especially in the short run. Typically, investing is a little bit scary. However, if you zoom back and you look at the great landscape of investing over the course of time, investing in well-established companies that continue to grow ultimately are the most stable investments that you can own, regardless of who the president is, what inflation is doing, what are the tax rates, anything that's going on in the world. So if you're sitting on the sidelines, I would definitely suggest looking for opportunities to start investing. If you're unsure of where to invest, you could always invest in things that are conservative, such as bonds, certificates of deposits, or treasury notes or bills, things like that. So that way, if inflation is 4%, you want to be making at least 4% or more on your money to ensure you're keeping up with inflation. Because a lot of people I meet with that come into money, they're scared to lose it. And if you're scared to lose money and you never do anything with it, eventually, because of inflation and taxes, your money is going to quickly, over time, start to lose value. And that's the importance of investing, is to make sure that your money is at least keeping up with inflation. The overall goal is to outpace inflation. And by outpacing inflation, that's truly the only way to build sustainable long-term wealth when it comes to your financial future. So other than that,